Welcome to another episode of Ask the Money Guy with Brian Preston and Bo Hansen.
That's right. You guys have financial questions. We've got your financial answers. You can go out to our website, moneyguy.com. You can leave a comment in the comments below, or you can go to your favorite social and use the hashtag #AskTheMoneyGuy.
It's Brian Preston, the Money Guy.
So Brian, today's question is one we get all the time, especially now that we've kind of laid out how we think you ought to look at car purchasing. And we talk about the value of money and how you should let your army of dollar bills work. So we get this question all the time from folks. Hey, if I'm offered 0% on a car loan, or if I'm offered a really low interest rate on a car loan, wouldn't I be crazy to not take advantage of it?
Free money. That's free
right.
money. Well, before we kind of jump into the answer, I think it's really, really important. Let's get some fundamental understanding of what we mean when we talk about Money Guy principle of 23/8.
Yep.
We're talking about on vehicles, we want you to put down, if you are going to finance it, you have to put down 20%. You have to finance it for no more than 3 years, and then it can be not exceed 8% of your gross income. And that's only for normal cars. If it's any type of luxury brand whatsoever, you have to treat it as 12 months, same as cash, meaning you're not buying any luxury brands out there unless you can pay them off within the first 12 months.
So the natural progression would be, okay, well, how does that information change? How does that guidance change when the interest rate is 0? And here's the answer. It doesn't.
Yep.
You still have to do 23/8. You want to put 20% down so that you're not driving a car that's underwater, because the worst thing that you could do is go finance 100% of your car, drive it off the lot, take the depreciation, get in an accident, have your car totaled, and the check that the insurance company writes you is less than what the loan on the car is. We've actually seen this happen. So you want to make sure that you have some equity in the car. And even at 0%, a car is a depreciable asset. It gets less valuable through time, so you certainly don't want to finance it for more than 3 years because of the rate at which that asset depreciates. And so you definitely want to make sure that you're still subscribing to 23/8, even on low financing.
Well, the thing is, I think people, because this is what they get thrown, is they'll say, Brian, they are offering me 0% or 1.9% for 5 years. That is such cheap money. Shouldn't I take it? And my answer is yes. And I'm even okay if you take a 60-month or 5-year loan, but it is exactly what you said. You're still going to pay it off in 3 years. It doesn't matter that the coupon booklet that they send you or the email they send you with your payment reminder, if you're doing this through a paperless method, it's still going to be that you're going to have a payment coupon that's this lesser amount, but then you're going to be paying more, because car loans typically don't have prepayment penalties. So you can verify that, but usually you can pay it at a much more rapid pace than what they're doing, because they want you to stay in debt on it. Bo, you told me recently that you dropped your car off to get some service done. They had somebody in the sales from the sales department waiting in the service department. And what was his once-in-a-lifetime offer for you?
Dare I say lurking in the service window. And this is what they told me. They said, hey, your car sure has held up really nicely. Do you know that today I'll give you this much? And if you wanted to get into a brand new car, twice as expensive as what they said my current car was worth, it would only cause my monthly payment, if I had a monthly payment, to go up by $40 from what I originally purchased my car. So for $40 a month, I could be driving a brand new 2020 automobile. It was just insane. And the reason they would do that math is because they wanted me to finance it over, 5 years, 6 years, maybe even 7 years to make that math work. It is a losing proposition.
So it is a financial sleight of hand. And that's something that you see in the auto industry all the time, is they try to not get you to focus on what you owe on the car or what the car is worth. They want you to focus on the payment. So that's why when we tell you guys, pay it off in 3 years, this is what's going to insulate you from being upside down in the value. Because we all know new cars and cars in general lose tremendous value. I think it's like 40% in the first 2 years, 50% for some brands.
Yep.
So that's why you got to get them paid off in 3 years so that you don't get upside down. So it's okay if it's 60 months or 48 months, but you're going to pay it off in 3 years because you're not focusing on the payment like the salesman wants you to. You're focusing on getting debt-free, because the best driving car is a paid-for car.
This was a great question. If you have a question about personal finance, you can ask us and we'll answer it right here in studio. You can go out to your favorite social, use the hashtag #AskTheMoneyGuy. You can leave a comment in the comments below, or you can go to our website, moneyguy.com, and leave a comment there.
Money Guy team, out.